I received the following thought-provoking comment, which reads, "In my opinion, the whole point of COMEX is to make silver and oil cheaper than it should be to make our economy artificially stronger. It is all manipulation. Silver and oil will always be suppressed until the system breaks, which nobody knows when it will happen." Lot to unpack here. Certainly feels about right. Let's examine. Have you ever wondered something strange? Your grandfather bought gasoline for pennies a gallon. Today, you pay several dollars. Your house costs 5, 10, maybe 20 times what it did decades ago. The stock market is hundreds of times larger. The national debt has exploded from less than 1 trillion when I was younger to 35 trillion plus today. But oil? A barrel of oil today costs roughly what it did in 1970 when adjusted for inflation. And silver? The metal that powered photography, electronics, solar panels, medical technology, and military applications, just to name a few. Silver is still trading at prices that, compared with inflation, look remarkably similar to decades ago. So the question becomes, is oil really that abundant? And is silver really that cheap? Or is something else happening underneath the surface? Because every financial market has two prices: the price you see and the price the system needs you to see. Today, we are going deep inside the strange world of commodity pricing for the world's two most important commodities, oil and silver. Page 1, the great commodity paradox. Let's start with something uncomfortable. If you simply look at inflation, the numbers don't make sense. In 1971, the United States left the gold standard. Since then, the purchasing power of the dollar has declined dramatically. According to the Federal Reserve inflation data, the dollar today buys roughly 15 cents of what it bought in 1971, if you believe the new math. Everything priced in dollars should theoretically rise: real estate, stocks, labor, raw materials. The commodities have behaved differently. Take crude oil. In January 1981, oil reached approximately $40 per barrel. Adjusted for inflation, that would be well over $150 per barrel today. Yet here we are, decades later, and oil has spent much of the recent years trading in the $60 to $90 per barrel range. Now, there are explanations. Technology improved. U.S. shale production exploded. Energy efficiency increased. New discoveries expanded supply. All true. But there is another factor that changed the commodity world forever: the financialization of natural resources. Which brings us to page 2, the paper market. To understand commodities today, you have to understand one word: futures. A futures contract is not necessarily a barrel of oil. It is not necessarily a 1,000-ounce silver bar. It is a financial agreement representing a future transaction. And this is where it gets interesting. The largest commodity exchanges in the world, including the Chicago Mercantile Exchange and its metals division, operate markets where traders buy and sell enormous quantities of contracts. And the purpose, supposedly, is price discovery, hedging, risk management. A farmer can lock in grain prices, an airline can hedge fuel costs, a mining company can protect revenue. That is the legitimate purpose, but critics argue that the size of the paper market compared to the physical market creates distortions, especially in silver. Silver is unusual. Unlike gold, much of the silver produced is consumed. It disappears into electronics, solar panels, industrial equipment, medical applications, and a silver bar used in manufacturing does not come back to the market. According to industrial estimates, annual silver demand has exceeded mine supply in recent years, requiring inventory drawdowns and recycling. Meanwhile, futures markets can represent many multiples of an annual production. That creates a fascinating question. When millions of ounces of paper, silver, trade hands, how much physical silver actually exists? Which brings us to page 3, silver by the numbers. So let's look at the numbers. Global silver mine production is roughly around 800 million ounces annually. Total demand has approached or exceeded 1 billion ounces in recent years. Industrial demand alone has become a historic driver. Solar panels are now one of the largest sources of silver demand. The Silver Institute has estimated industrial demand reached record levels as solar manufacturing expanded, and yet silver prices remain nowhere near their inflation-adjusted highs. In January 1980, silver briefly reached approximately $50 per ounce, but adjusted for inflation, that would be well over $150 per ounce today. Yet silver has spent much of its modern history trading dramatically below that level. So why? The argument from many silver investors is simple. The market has created a disconnect between paper pricing and physical reality. We point towards the difference between registered silver, eligible silver, and available inventory, and the enormous amount of contracts traded compared to the actual metal available for delivery. Now, market participants disagree about what that means. Some say the futures market simply provides liquidity. Others believe the system keeps prices lower than they otherwise would be. But everyone agrees on one thing. The paper market matters a lot. Page 4, oil, the other side of the equation. So let's talk about oil. Because oil is even more important. Oil is not just another commodity. Oil is the blood of the modern economy. Transportation, agriculture, manufacturing, military power, everything depends on energy. And here's the strange thing. Energy has become cheaper relative to almost everything else. And think about this. A smartphone contains technology that would have cost millions of dollars decades ago, yet energy remains remarkably affordable. Why? Because cheap energy is the foundation of economic growth. Every major industrial power understands this. Cheap energy means lower transportation costs, lower manufacturing costs, lower inflation, a stronger currency, and a more competitive economy. That is why nations have always cared about energy prices. Page 5 is the system designed for cheap commodities. Now this is where the debate becomes fascinating. Some analysts argue that modern economies require inexpensive commodities, not because of a secret agreement, but because the entire financial system is built around affordable energy and raw materials. Imagine if oil suddenly went to $200 per barrel. Transportation costs explode, food prices rise, inflation accelerates, interest rates increase, debt becomes harder to service. The entire economic machine faces pressure. The same argument applies to silver. Silver is both a monetary metal and an industrial input. Higher silver prices could increase costs across solar, electronics, automotive technology, defense systems. So some investors argue the system naturally favors lower commodity prices. Others go further. They argue that the financial markets actively reinforce those lower prices through leverage, paper contracts, and institutional positioning. So, page 6, the big question, when does the system break? And this is what brings us to the comment that started the conversation. Silver and oil will always be suppressed until the system breaks. That was the comment. That phrase, until the system breaks, is the part that captures people's imagination, mine included, because history shows something important. Markets can remain irrational much longer than investors can remain solvent. But eventually, reality wins. In the 1970s, policymakers believed inflation could be controlled forever. It could not. In 2007, many believed housing prices could never collapse nationwide. Spoiler alert, they did. In 2020, many believed oil prices could never go negative, but, well, you probably remember that they did. Markets are powerful, but they are not magical. Eventually, supply and demand meet. Basic economics. Eventually, physical reality matters. Eventually, the numbers on the screen have to connect with the world outside the screen. So maybe the question is not, are silver and oil manipulated? Maybe the better question is, why do some assets that are essential to civilization remain so inexpensive compared with everything else? Because history has a funny habit. The things we ignore because they seem ordinary sometimes become the things we desperately need. A barrel of oil, a silver round, a handful of raw materials buried beneath the earth. Things that look boring during calm times, but become priceless during uncertain ones. And perhaps that's the lesson. Markets can create prices, but they cannot create resources. They can create paper claims, but they cannot create barrels. They cannot create ounces, and sooner or later, the world has a way of reminding us of the difference. And now you know the rest of the story for why oil and silver are momentarily cheaper than they should be. Build that stack. iBankerU. Good day.